just give it a couple of minutes here and let the poll finish up, and then we'll close that out. I can't share my files just yet. My name, just a little bit about myself. My name is Randy Urban. I'm a TSP Training and Liaison Specialist here at the FRTIB, or the Federal Retirement Thrift Investment Board. And what I put together for you today is just a little bit of an intro into the plan, where it fits. And then probably most of you listening in today want to hear about a lot of the changes that have happened this year, changes that we have upcoming. So some of this may be just refresher stuff for you, but we also have been going through a lot of changes with the coronavirus, of course, and the CARES Act that affected the savings plan. So we're definitely going to go over that, and at some point I'm going to try and share the screen and go to our website, which is also a major change this year that took place just recently, and we launched the new redesigned website. So if you haven't been to tsp.gov in a while, take a look and see what it's like. It's quite a bit different than it was before, and it's going to take some getting used to. I'm still getting used to it myself, used to where things are and how things flow and so forth. But a big change there. And I'll show you the agenda. Whoever can read phones. All right. All right, so as I was saying, the updates that we'll go through today and try and touch on every area I can think of that is happening. But there's a lot of things happening. A lot of things are sort of fluid. And just keep in mind with all of the COVID or the CARES Act legislation that passed, these are temporary changes. So many of them will end at the end of this year. Some of them have deadlines that are coming up pretty soon to get things done. But a lot of that is pretty much temporary changes. We've actually sped up some things that we were planning to do and get those in place in terms of submitting forms online and things of that nature. So those are more permanent changes. And then, of course, the L funds. And I'm sort of just going through the agenda right now for folks that may have just joined. So until we can get through the poll and I can bring up the slides. So the other big change that happened just last month was the new L fund and the 5-year increments for the L fund. So that was a pretty big change there also. So we'll get into those and talk about how that's working for just a little bit. Let me see what else I have on my agenda here without going too far ahead here. And like I said, I'll try and take you to the website just for a moment or so here and there and show you what that looks like and where things are located, finding information. So I'm not sure how much longer we'll have the poll up, but well, let me bring the slides up without them. So I'll just go through the beginning of this and just sort of talk about what we're going to be talking about at the beginning. And basically, TSP, of course, is one of those major components of retirement. So participants, I always encourage people who are working with participants to sort of put it in that perspective of what TSP is built for and designed for, and how important it is, of course, for your overall retirement. And the main thing is the fact that participants have the ability to make major decisions, and they have to. They have to decide to contribute. They have to decide how much they're contributing. They need to make decisions in terms of how they're investing that money. And then on the back end of things, of course, they're deciding on how they're going to withdraw the money, which we went through those big changes last year, as many of you know, with all the legislative changes back in September that we launched last year. So some pretty big changes overall that are happening that affect things that participants have to do and information they have to understand and know. And even those, I always tell participants too that even when something big like what we went through last year in September as far as the withdrawal legislative changes, when those things happen, you get to a point where those things can tend to get, altered, amended, and so forth. So even what of last year, there are things now that we're working on that may amend some of the stuff that we launched last year to improve it and so forth. So there's always things that are being worked on. looks like, there they are. All right. So once again, my name is Randy Urban. Let me just, I'm not going to read this whole disclaimer to you, but this is basically just letting you know that, the presentations that we do as part of the Education and Outreach Division at the Federal Retirement Thrift Investment Board are intended for educational purposes only and do not replace independent professional judgment. Nothing we're doing here is going to be any kind of endorsement. We can't endorse products or services of third parties, and nothing should be construed as legal, medical, tax, investment, or financial advice. So, basically what that's saying is what we do is we educate and we inform, and we hopefully help you understand the plan a little bit better. And I always try, and when I do events with the OPM, I try to, look at it from a perspective of somebody who's going to be working with participants. But, you have your TSP accounts too, so you want to understand it on that level also. But like I said, we're going to just briefly talk, and I was doing that already, a little bit about the plan and where it fits, and sort of weave in changes and things that are happening, have happened, will happen real soon. So, of course, we'll probably spend a lot of time on CARES Act, a little bit of that information. I'll try and go to the website and show you that. The life cycle of funds and so forth. So let's just dive into this a little bit more here. Like I said earlier, TSP, of course, is one of those major components of retirement income. So you want to take advantage of it as much as possible for as long as you can. And many participants will use TSP in their career and then even into retirement. And for the rest of their life, they'll have a TSP account. So it does play a major role in your retirement. And as I was saying earlier, the participants have to make those major decisions. They decide, how much to contribute. And right now, this year, of course, we've been doing our series of webinars on the plan, and we do our specific webinars on investments and in the funds and so forth. And a lot of times, participants are asking, what should they do right now? How do I invest? What do I do? What do I don't do? Well, obviously, we can't give advice, but, one thing we can tell them is this is a long-term process. This is more of a, you're building an account, building an asset that you're going to use in retirement over many years. So you have to put yourself in perspective of where you're at on your time horizon and your levels of risk that you're willing to take. So what is your risk tolerance at any point in your career or your life? Those are things that will generally guide what you're going to do and how you're going to make decisions with the plan. But ultimately, you, the participant, do have to make those decisions with TSP, as opposed to your employer plan, your service annuity, and what have you out there that are more formula-based, predetermined, as it says there, systems and plans. So how long you make contributions, how much you make contributions up to the limits. Of course, we don't know what the limits are until IRS lets us know what those are sometime in October. We generally find that out for the next year. It's going to be interesting to see what happens this year, because as I understand it, the formula they use for that is somewhat based on consumer price index and inflation. So we'll see how that works out for next year, whether the numbers stay the same or whether they get increased or not. I don't get into all the Googling of speculation about that until I get closer to October, but we're getting there. So how much your balance grows, and that's the investment part of things, and that's a pretty big decision right there to how you're going to invest and how you might rebalance things from time to time, or whether you use the L funds or what have you. And this year, like I said, is a very, very good example of how people can really make some bad decisions in terms of how they're investing in the plan and moving money around, interfund transfers and so forth. If you're going back to March when we had the big, there's a big, huge dip back there, but most of that has recovered since March in those funds. So, if you got out back then and stayed on the sidelines while the markets rebounded, you locked in losses and you waited to get back in when the markets are higher, so you bought in higher. So it's really hard in a plan like TSP to time markets and do those sort of things. So you have to think more long term. You know, if you're not going to be touching your money for another 10 or 15 years down the road or longer, then you have plenty of time to withstand the ups and downs of markets. But, you know, that's participants' prerogative, how they're going to invest and what their portfolio looks like at any one time throughout their career. And then the expenses, the overall expenses of the plans. That's a major, major role, and something participants have typically over the years not spent a whole lot of time focusing on. But it is a major player in the game. And you want to know not only what their expenses are, any kind of hidden fees in a plan or anything like that. So that's something we've always disclosed, all of that type of information. Private sector plans haven't always had to do that. They do in a bigger, different way now. And then whenever I'm in front of a live audience and I ask the question about what areas affect your TSP account, I always get the answers of, you know, withdrawals and loans. And of course they do. If you take out in-service withdrawals, if you take out a hardship withdrawal, if you take out loans, that is definitely going to have an effect on your account balance when you go to use it in retirement. Now, this seems very simple, but in many, many years, I've been dealing with this plan in some way, shape, or form since 1993. Participants have always struggled with the understanding that the payroll office is not your TSP. The payroll office facilitates your TSP to send us the indicative data, the personal data, and of course, contributions and so forth. So I always tell participants out there, you know, think about what you're asking and what it affects. If it affects your paycheck, you're probably going to your payroll office for that and to make changes and so forth. So you have to go through, and many participants don't understand that there are many different payroll offices, payroll systems, I should say, probably, out there. So if you want to start, stop, change, resume, as it says there, if you want to add Roth contributions, anything like that has to flow through your servicing payroll office. And even things like your address, of course, while you're still in an active status. Those are all going to flow through the payroll offices. You guys know this. And the limits, let's talk about the limits. We have a couple of months left for this year, of course. So the limits are still $19,500 for the regular elective deferral amount. Could be traditional contributions or Roth contributions. And of course, there is the annual additions limit, which is something most participants don't really pay a lot of attention to. Probably more on the uniform services side of things will pay attention to this number. And then that's only a select few folks out there, probably not a very large number of folks that actually can reach that amount in their own contributions. But it's possible on that side due to the service members being able to put in incentive pay and special pay and bonus pay in addition to their contributions. So the regular contributions, of course, the $19,500 fit in that annual additions limit, as do the matching and the 1% from services and agencies. That all fits. I call it an umbrella amount. It sort of catches all the amounts that I just spoke of. And then there's the third limit that you see there, of course. That's a separate amount, and that is the catch-up contributions. Now, I'm saying that emphatically that it's a separate amount this year, but it will change a little bit. And I have a slide, the next slide, that will help you a little bit with that. You're probably familiar with, or at least heard about the fact that we're making some changes to how the catch-up contributions come in. So these are the limits for the remaining part of this year. They can all be combinations of traditional and Roth contributions, of course. Let me just see something right here real quick. Okay. So and here's a question that just popped up here. Now, I have no problem grabbing questions as they pop up in the chat, if they fit that area we're in at that time or whatever, or if you guys, I could come to some points where I can just ask for general questions. Either way, works for me. Either way, the question from Samantha says, what is the 415C annual additions exactly? So the 415 limit is just an overall annual additions limit. So if I had multiple plans of the same type, then those numbers could fit underneath that. I always use myself as and the second part of your question, it says who is eligible to participate. Well, that's a really good thing to bring up, and I'm glad you asked it that way. The annual additions limit applies to everyone. So all of these limits you see here, these 3 limits are IRS limits. So they're not specific to TSP. They apply to other similar types of plans. So the annual additions limit applies to everyone in TSP. And the reason I emphasize a little bit more about the uniform services is that if I'm just strictly a first participant, which I am, and I only have my 19.5 going in this year, plus my 1% match, 1% automatic, and my matching, if I put all those numbers together, it's not going to exceed $57,000 this year. I'm not even going to come close to reaching that. So and it's the only thing I have, me personally, I'm using myself as an example. I don't really pay that much attention to it personally because I'll never reach that. But what if I had multiple plans in the same year? What if I had my civilian account and my service account where I got big bonuses on the service side of things that I can put into my TSP? So I can actually potentially, depending on my salary, reach those numbers if I, combining everything. It is possible for some people to do. So that $57,000 does include everything. It includes the 19.5, but it doesn't include the catch-up contributions. So even the $6,500 for catch-up contributions is on top of the $57,000. The $6,500 for catch-up contributions is on top of the $19,500. And that's why your question is a good question, because I've had participants, get a little bit confused about that, thinking that this annual additions thing must be for someone else, or it's just for uniform services, because I sort of emphasize that sometimes when I do these. It is not just for uniform services. It is for any civilian and uniform services accounts. It's just that if you're just strictly a civilian, the numbers won't add up just in TSP. If you had other plans, then that gets a little bit more complicated if you had other plans outside of TSP in the same year. These are annual limits for the calendar year. So the annual and then Melissa's question here says, how do you contribute those annual additions? Well, the everything that you're contributing, like I said, your regular amount on the 19.5, the agency and service 1% and matching, all of that is coming in naturally. You're contributing. You're going through your payroll office and doing that. Anything extra that I'm mentioning, as far as like the uniform services goes, those bonuses, special pay, and so forth, they'll be doing the same thing. Those come in through the payroll office. So uniform services, the MyPay system, you go into MyPay, and then they're going to have those other abilities to contribute. It's much like a civilian has with traditional and Roth contributions. They have other parts in those systems where they can contribute the special pay and the bonus pay and so forth. And you always have to remind yourself, too, that contributions only come into TSP one way. And this is a very common question. Can I just write a check and send money in, things like that? And the simple answer for those questions is that contributions only come into TSP one way, and that meaning contributions directly as a contribution itself. I'm not talking about something that you would transfer or roll over that you contributed to another plan, which we know we can do that. We can transfer other plans like 401ks, 457s, 403bs, traditional IRAs, simple SEPs, all those different types of employer plans and IRAs. Those can be transferred in, but you contributed that to another plan, and now you're just transferring that money into TSP. So I'm strictly talking about contributions that come in. They can only come in through payroll deduction. So if it's not something I contributed to through my payroll, then it's not coming into TSP unless you contributed to another plan and then transferred it under some of those circumstances into TSP. So yeah, it is in his question. So it's basically a total of what you're putting in under the 19.5, and then plus the matching 1%, and for service members, those other types of pay, special pay, bonus pay, incentive pay, different things that they can receive are included in this. They get pilot pay, reinvestment bonuses. There's a new continuation pay bonus that is with the new BRS system. They can put that into TSP. They can even spread that over a couple of years. So there's a lot of things that on that side they can be contributing. But, you know, depending on your rank and how much your salary is, of course, that also is going to have play a role in, well, you know, how much the matching 1% is and things like that. All right, so the annual additions limit is not just applicable to TSP, so just keep that in mind. It applies to other plans. This is, if you looked it up and looked up the 415C limit, that would refer to what the IRS rules say about these types of plans. So it's not specific to TSP. None of those limits are specific to TSP. All right. I haven't done a class for OPM in a while, and I have to remind myself that you guys are asking questions that are a little bit off of what a normal participant would ask, but great questions nonetheless, and similar to, I shouldn't say it that way. But let's move on to the spillover method that's going to kick in next year. So, of course, if you're not familiar with our website and the bulletins, I'll try and show you guys how that's changed also on our website. But we have bulletins that pass along information about things that are happening, and they're much more intense and extensive in the information than what you're seeing here on this one slide. But the plan is that we're going to launch the spillover method next year for catch-up contributions. So basically what this means is that starting in January, as it says there, participants will only have to make one election to contribute. So your regular 19.5, and let's just pretend all the numbers stay the same next year. So the regular 19.5 and your catch-up contribution, that $26,000 total, you're only going to make one election, whereas this year you have to make two separate elections to contribute as a catch-up contribution. So let's just pretend that I'm going to contribute $1,000 pay period on a 26 pay period schedule. So I'm going to roll along, and when I get to, what is that, pay period 20? Pay period 19, really. I'm going to reach the 19,500, and then the extra money that keeps going in, and I have to continue to contribute, will start going into the account as a spillover into the catch-up contribution portion. Now, this is obviously only for participants who would be eligible for the catch-up at that time. So the key here is that the participants still have to continue to contribute. It's just that we're trying to negate the mistake that some folks make when they don't contribute enough to get the full match. They miss out on matching, and they somehow maybe screw up the numbers in some ways too, and they miss out on the maximum that they can contribute. So in other words, the $1,000, let's just say this scenario we're using, the $1,000 a pay period is going to continue to go in even though they've reached the 19.5. See, under this year, it would stop. So 19.5 would be reached at a very early pay period, and I would also miss out on, so I would miss out on contributing further in that year unless I went in and I was doing catch-up contributions. But this year, catch-up contributions don't play a role in the match. Well, that's also going to change next year. So as that money starts to spill over into the catch-up portion at the latter part of the year, then that catch-up contributions, those contributions will be used to determine the match. So in other words, you're still going to have to make sure that every pay period you're always contributing 5% to get your full match, even though you may reach the limit and now the money's starting to spill over into the catch-up contribution portion. So those folks will continue to get the match based off of the catch-up contributions. So that's a pretty big change that's happening next year. And hopefully, like I said, that will curtail some of these errors that participants have made in missing out on matching at the end of the year or the latter part of the year, and maybe messing up the numbers in some ways. So it's going to be interesting to see how that plays out. But that's something that's been worked on for a while now, and the payroll offices are all updating systems and so forth, and they're going to go ahead and launch that in January of next year. So you'll see more of this, but if you want the bulletin, it's that bulletin 20-1. You can go right in there and read up on about it. The other thing I wanted to pass along, if you're not aware yet, that in just about a month and a half, 2 months, you will see a change with the automatic enrollment. So automatic enrollment will be changing from 3% to 5% beginning October 1st of this year for all participants on both sides, civilian and uniformed services, that is. So this won't change anybody before then. It's just that people who come on board October 1st moving forward will be automatically enrolled at 5% instead of 3%. So that's a pretty easy one to understand, but it's closing in on us. We're going to see that change, and that's a really positive change, of course. Here's a question from Ricky. Says, what if someone reaches the $19,500 before the end of the year and they don't want to contribute to catch up? Will they have to submit a TSP1 to stop the spillover? So if you're eligible for the catch-up contributions and you do not want to continue contributing, yeah, that's going to be interesting. I don't know how the systems are going to be set up exactly for that, but you would have to go in and stop contributions, yes. So you're going to reach the limit. It's going to continue contributing, and it will fill up into the catch-up contributions. I'm going to follow up on that question and see if there's any kind of notice. Now, we send out notices for just about everything, so I'm almost positive there's a notice that may be going out for that, and they might have something like that built into the system, but they may not. I don't know of anything specific that will go out. Now, I would imagine that most of the websites, the systems will have some sort of information and explanation on what's going to happen. The participants should be reading and understanding. But yeah, it will automatically happen if you are eligible for catch-up contributions when you reach the limit. I don't know of any kind of alerts or anything like that. And that may be system to system too. Like I said, we don't control those payroll office systems. Those are not ours. So whether or not a payroll system has something built in to send out an alert to somebody that says, hey, your funds are spilling over into the catch-up contribution, I don't know that will be the case for anything like that. If they could, I think that would be a positive thing to do. But that's a good question. I'll have to follow up on that to see what's going to be built in for any kind of possible alerts or anything like that. But ultimately, yes, you would have to go in and stop contributions. We don't have the capacity, I can tell you that much from our side, to stop contributions. Whether or not a payroll office system has capacities to do that automatically or allow them to submit something like that, or how that works exactly, I'm not sure. But I'll follow up on that. Let's see. And that's a good point. Pauline brought up a good point. And this was my biggest concern when we first started talking about making this change. My biggest concern was participants have to really understand that this doesn't mean they can just stop their contributions at $19,500 and they will continue to get the match. The important thing to stress is that they still have to make sure that they're contributing. So if you get to $19,500 and you are eligible for catch-up contributions and you decide to stop them, you're going to miss out on a match. So you're going to have to at least do 5% for the remainder of the year, each pay period. That will, they'll go into the catch-up portion, but you're going to have to make sure that you're always putting in the 5%. So remember, and that's a good point to bring up. This is something that will only affect those folks out there that are eligible for catch-up at the time. So, all right, good point there. Try not to get too talkative and too wordy here. I don't have the timing down for this particular class. I just sort of put things together that I thought would be good things to talk about as far as updates and changes. And there's a lot to talk about. We are actually doing, we've done a few, and we're going to do a few more each month, specific webinars just on the CARES Act and the TSP. So there's a lot of information to get into. So the CARES Act passed back in March, and this created special rules related to COVID-19. And of course, so that affects your TSP. So at the time, we had created a webinar page, and we still have it. There's a ton of information in there. You can simply just put in tsp.gov/COVID-19, so COVID-19, and that'll take you right there. In fact, let me just see if I All right, so you should all be seeing the new website, tsp.gov, and it looks a lot different if you haven't been in there yet since we've changed things. So like I said earlier, you can just put in tsp.gov/COVID-19 and it'll take you right to the page I'm referring to. Or you can just go to the homepage and just sort of scroll down. At the bottom, there's a section called News and Resources. And this is sort of the old bulletin board page section and so forth, where you can see the plan news and information that we put in there, facts and so forth. But if you just go down to the bottom here, there's a COVID-19, and that'll take you right to the page. You can get specific to the withdrawals, specific to loans, the RMD changes. So there is a lot of information. I'm going to go over just a small portion of this today. But if a participant really wants to read up and find out about it, here's all of the information. Now, there's a few things that I'm not sure I have on my slide, so I want to bring some of those up. This temporary acceptance of PIV and CAC signatures on TSP forms, that's brand new. That just came out this past, well, I should say last week. So we're temporarily accepting certain digital signatures on forms. So that's brand new and new information in there. So when you go into the forms and signing forms, installment payments. So, and this is some of the stuff I'm going over right now is not on the slides, but the installment payments, when you take out installment payments in a post-service, you have the option to start those out as a fixed dollar amount or a based on life expectancy. So on the IRS life expectancy tables. Now, the thing that all this is telling you right here is that when you stop those life expectancy payments and you want to restart them, normally you have to restart them on the fixed dollar side. That will change in 2021. So what we have right now is we have some participants who have decided to stop payments because of the RMD changes that I'll talk about in a bit. And what they need to understand is that they stop those payments on the life expectancy side. They'll have to wait until January of 2021 to restart them on the same side. So it'll be a few months before they can stay on that same side. The rule that was in place prior to this and for the rest of this year will be that if you stop the payment on the life expectancy side, you can only restart them on the fixed dollar side where you actually set the amount yourself. That's what that's talking about there. I'll talk about the forms online in some detail. I have a few slides on that. And some of the stuff I will be going over too. We have temporarily waived the requirement for notary, so signatures that need to be notarized. So that's a temporary thing. And that, of course, has to do with the social distancing and so forth. So temporarily, the system will accept the forms without the notarized signature. Now, the key here is that that still has to be signed. So it doesn't mean it doesn't have to be signed. It just means that we're not going to require the notary for this temporary time. All right, so I'll get out of this. Let's see what else I have here I want to show while I'm in the system. All right, so if you scroll down, and a lot of these things you can just put in tsp.gov/ and whatever it is, like tsp.gov/calculators. But if you want to know where the calculators are located now, you go down to the same bottom bar there. Click on that, that'll bring those up. The agency service rep resources. So the bulletins. So those are located in the same bar at the bottom, and you can bring up all of those. It's a little bit different in how you find them and so forth. It's a lot different, I should say. But that's where you'll find that, announcements. And this is where the training section is for our webinars that we do, if somebody's looking for those. And once again, they can just put in tsp.gov/webinars, and it'll take them right there. And what else am I going to try and show you here without getting too out of control here with the website? There's one other thing I wanted to show you. The calculators. Let's dive into that just a moment. I want to show you one specific calculator that maybe it's already been, we're working on updates to this particular calculator. So the TSP payment and annuity calculator is still being worked on for updates. So that one I was told last week it could be launched as early as this week. So we'll see if it comes up sometime this week. But they're working on that one. All the other calculators that we normally had there are still there. I do apologize. I'll come back to your questions. I see some of the questions popping up, but I can't see them all while I'm in the share screen mode here. If you've ever worked with with WebEx and these things. So as you can see, a lot of differences here. I think if you've been to our fund section about the different funds, you're going to see some major differences there. We don't have the pie charts anymore. We have more, a little bit more extensive information that people can scroll through and get annual returns or monthly returns and so forth. So it's very, very different when they're going in there and they can see different types of information and fund performance. All right, so I'm going to stop sharing here and let me grab, I see there's only one question I saw pop up. Well, there's two questions. Maybe there's more than that. Let's see. All right. So here's a question saying to confirm the employees eligible for catch-up will now get matching on those funds. Yes. So starting next year, when that money starts to spill over into the matching, into the catch-up, I should say, because they're not going to have the ability to, it's not going to be two separate contributions. So starting next year, it's going to be one contribution that would include both your regular, the 19.5, and the 6,500 once they reach the 19.5. So they're not going to have the ability to make a separate election for catch-up. They're going to have to increase what they're contributing and include it. And I'm glad you asked that question because it reminded me how I wanted to present this a little bit more. But you really have to look at this as a combined amount. So let's look at this as the $26,000 total starting next year for someone who's eligible for catch-up, because you're going to want to make sure that you're contributing enough to reach $26,000 if you want to do both of those. You want to max out within just that one election to contribute. So yes, so the 1,000. Let's just say I was doing $1,000 a pay period, 26 pay periods. Boom, there you have $26,000, and the spillover will happen at the latter part of the year. Now I don't know what the numbers are going to be next year, so let me just make it clear to everyone. I'm just using that as an example. We'll find out what those numbers are in October. Usually, that's when IRS announces those numbers for the next year. And yeah, the 5%, so the basic, so the matching the 1% is still the same. None of that changed. That's based off your basic pay. So your basic pay and in that pay period. So if you reach the 19th, so the next part of this question says, but if you reach the 19.5, say in October, you can keep making contributions or payments via the spillover and keep getting the match. Yes. All right. Definitely. Let's see. Okay. Samantha's here asking, are these temporary changes specific to request under the CARES Act or for regular normal loan request? So these are going to be specific for the CARES Act, and I'm going to show you that right now. But I want to answer one more question here from Daniel. It says, does TSP accept electronic payments in lieu of checks for TSP loans? Not right now. You still have to send in a personal check, a cashier's check, and you have to send it in along with the TSP loan coupon that you can get from the website. So they still would have to do that. So let's get into CARES Act just a little bit here. And I mentioned that it's, was signed in March. I showed you the website there. Now, the key thing here is to understand about these temporary changes. These are things that you have to be affected by COVID-19. So they set up 3 separate criteria that you have to meet at least one of these to qualify for the loans and the withdrawals that we're talking about and these changes. So either you have been diagnosed, you are or have been diagnosed with COVID-19, your spouse or dependent is or has been diagnosed with such virus. And then the third part is a little more complicated. Due to COVID-19, you're experiencing adverse financial consequences as a result of you, your spouse, or a member of your household experiencing any one of the following that you see there: being quarantined, being furloughed, laid off, or having work hours reduced, being unable to work due to lack of child care, having to close or reduce hours of business, having a reduction in pay or self-employment income, and having a job offer rescinded or a start date for a job delayed. Now, there is a form. I'll get to that in just a second. But there is a form that IRS is going to make available soon that participants will have to use when they file their taxes next year. So a lot of the questions that we've been getting already are things like, how do I determine eligibility? How do I put that on a form and things of that nature? You're going to self-certify that you are a qualified individual, and we won't be playing any role in that eligibility. The FRTB does not play any role in that eligibility. So you will have to submit a form, and if I remember the number of the form off the top of my head, it's 8915-E. If I remember correctly, it's 8915-E. But it's not available yet. They're going to make that available sometime this year that participants would then have to use when they file their taxes next year. Now, you're not going to want to send in any kind of documentation along with any of the forms that we're referring to here. No medical documentation, nothing. Do not send anything in, just the form. That's all we need because, like I said just a second ago, we don't play any role in determining eligibility for this. Now, the parts that are affected by this is there's an increased maximum loan amount. Now, this loan is treated just like a general purpose loan. There is a separate form. We created a separate form for this, but it is treated like a general purpose loan. So that means the old rule of you can only have one general purpose loan still exists. So if I have a general purpose loan, this CARES Act loan or increased loan amount is not eligible. I'm not eligible for it. Okay, so I cannot have two general purpose loans out, and this is being treated like a general purpose loan. Now, the biggest difference about this is the $50,000 limit was increased to $100,000. So I could take out a loan of $100,000. Now, I can also suspend current loan payments or loan payments later on. That's part of this. These are all, once again, for qualified individuals. And we created a special CARES Act withdrawal. So there's also a separate CARES Act withdrawal that a participant can actually go in if they're a qualified individual and actually take out as much as $100,000 from their account. Now, this is a withdrawal. They will also have the ability to pay back this withdrawal. They'll have a 3-year period. Within 3 years, they could actually put that money back in. They can even spread out the $100,000 over the 3 years in terms of taxes. So they won't get the tax hit. They could spread that $100,000 they took out over a 3-year period. They are not being penalized. So the early withdrawal penalty does not apply for these. And this is something that a person in service or post-service can take out. So a lot of the rules that you're familiar with when it comes to in-service withdrawals and age requirements and things like that, none of those apply here. So there's no age requirement here. You don't have to be in service for this. Now participants could take out the withdrawal options in post-service that we already had before this. And it can fall under the CARES Act for this withdrawal also. So it doesn't have to specifically be this CARES Act withdrawal. But if you wanted to get the upfront treatment, and when I say upfront treatment means with this CARES Act withdrawal, you could actually take the $100,000 out and have no tax withholding. So we're not going to take out tax withholding for this amount up front. You can ask for tax withholding to come out of it to cover you for taxes, but you don't have to do that up front. So there's some specific benefits up front in terms of taxes to doing the CARES Act withdrawal itself. All right, and what else do I have in this section? All right, so let's go through some other things, and some of these are still sort of involved with the CARES Act and so forth, but I just mentioned earlier that the temporary suspension of loan payments. So if you have a loan that's out or a loan that you would take out later on this year, now there is a deadline for this. There's lots of deadlines involved with these things for this year. So you can suspend loan payments for existing loans and new loans taken before November 30th of this year. Now for this, we did create a new form, a form TSP-46, CARES Act loan suspension request. So you can submit that form to us and suspend a payment on existing loans, or maybe you take out a loan, next month or 2 months from now, and you want to suspend those payments for a couple of months. You can do that. Now this will only suspend the loan payments. Well, it will suspend loan payments through the end of the year, but participants are going to have to actually go in and well, let's see. Let me get the next slide. So this is, I'm sorry, I meant to say this is only going to suspend the loan payments throughout the rest of this year. Just trying to remember what slides I included in here. I apologize, folks. It's a new set of slides and don't have the flow down so well. But so this would suspend the loan payments through the rest of this year. Now, a few things about this, though, too. Participants will still have to stay within a 5 or 15-year window. So if you took the loan out for 4 years, then you shouldn't have any problem because they'll just stretch this out for the number of months that you suspended and continue, on that path. But if I took a loan out for the full 5 years, then the loan will have to be reamortized when those payments start up again, because I need to still stay in that 5-year window. So I have to pay it off in the 5 years, but I haven't been paying on it for these months that have passed. So it all depends on how long you took the loan out originally, whether you did it for, say, 3 years as opposed to 5 years, or for the residential loan say I took it out for 10 years. Well, then no problem there. The max is 15 years. So it shouldn't be a problem there. They'll just extend the number of payments. All right. So we changed, and you can now submit TSP loan and withdrawal forms online. So you will go into the My Account section to upload a form. When you get in there, and I'll show you a couple of screenshots of this, you'll see some instructions, and then you'll have the drop-down box and pick from the various forms. And we don't have every single form in there. So right now there's a list of forms that you can submit, and that may change at any time. You can only submit the form once, though. That's a real important part there, because if you submit it one time and you find an error, that first one's going to go through. You'd probably have to call us up and have it canceled and restart. That would be what I would encourage participants to do. If you find out there was an error on the one and you want to try to get in there and cancel it. But if you submit it 2, 3, 4 times, the second, third, fourth one is just going to be canceled automatically. So we will process the first submission that we receive and cancel any subsequent form of the same type. And that's not unlike the past. If you sent the form in multiple times, the first one we get is going to get processed and go through. In this case, of course, they're all going to be canceled after that one. So where are you going to get to that? I mentioned, of course, you're going to go into, it's a little bit different when you go to the website now. Just look in the top right-hand corner. It says log in, and just click on that. That'll take you to the My Account section once you get into your account. You're going to need your account number and password. We do have the new 2-step authentication, so there's more security for that there. But once you get in there, you're going to see the left-hand column there with account information and so forth. But down at the bottom, you see Upload a TSP Form. So you'll click on Upload Form down in that left-hand bottom corner. And that will take you to a page that looks like this. or they give you a drop-down box, I should say. So you can see some of the forms I'm referring to here in this list. If you see that TSP 20C CARES Act loan application. Now, I really want to stress to folks, even though it's a different form, it is treated like a general purpose loan. So keep that in mind. Although we created a special form for this, it is treated like a general purpose loan. So you still can only have one general purpose outstanding at the same time. Let's see what else I want to point out here. Well, there's the TSP 46, the CARES Act loan suspension request that I mentioned earlier. And down at the bottom is the CARES Act withdrawal request. And that's going to be specific. The TSP 96, that's the specific CARES Act withdrawal that we created for this and for the CARES Act for TSP. All right. One other thing in this section I do want to point out, very, very important, and I mentioned this earlier, and I can't stress it enough because I've worked years ago. It's been a while since I did this, but I worked in the document processing sections and things like that in the past. Do not send any TSP, do not send us, TSP, any documentation or private records, especially medical records, to prove any qualifications for eligibility. Now, this is for these CARES Act loans and withdrawals. We don't need anything like that. We don't play any role in determining your eligibility. You're self-certifying on the form when you sign the form, and then for the withdrawals, of course, you will have to, there'll be that special form that the IRS is going to put out sometime this year. All right, let me get to one more part here, and then I'll grab some more questions here. I'm kind of zooming along here, so probably could have put more information in this, but we'll get to some good question sections then. So RMDs. So we have suspended, or I shouldn't say suspended, we will not send any automatic RMD amounts for this year, for 2020. So what that means there is that if you were required to have an RMD come out and we automatically would send that to you, say at the end of the year when that comes out, then we're not doing that this year. None of the automatic RMD amounts are going out this year, later on this year. Now, some participants have payments coming out, but the only reason they're taking out those installment payments are to satisfy the RMD amount. Well, in that case, you'd have to go in and stop your payments. Okay, so the installment payments that you have coming out will still keep coming out this year, but if you're specifically taking those out just for the RMD amounts this year, you can go in and stop those for this year because you're not required to take the amount out this year at all. Now, many people have just decided, hey, I'm still going to take the money out, I need it, and so forth. So they're keeping that coming out. Now, what did happen is at the beginning of this year, so some of these laws, and of course the CARES Act didn't pass till March, they weren't in place. So you can actually roll over amounts that you've already taken out this year for RMDs back into a plan. It doesn't have to even be specifically your TSP. You can roll those over back into an IRA, an eligible employer plan, or even back into your TSP. Now, this one does have a deadline that's coming up pretty soon. So this has to be done by or submitted and received by August 31st of this year. That's a pretty big change, pretty big thing there, right there. Now, what happened also, and this is what I want to be specific on, is we previously had rejected some of these requests to transfer in. Now, they're going to use, you can see down at the bottom there, the TSP 60 form that we have for transfers into the plan. They'll use that same form. It's been updated and available. We had rejected some of those back in January and February, but we now have since gotten guidance from IRS that now allows us to accept such transfers. So if you have a participant says they sent it in and they were rejected for this, then they can now submit a new TSP 60 and it will go through. It's just that we didn't have any guidance on this at the beginning part of the year when those payments were going out, so we weren't able to accept those as transfers in. And really the form, I think the form's been slightly updated, that TSP 60s too, to allow for that. All right, so let me grab some questions here. So Samantha asked about, are these temporary changes specific to TSP? And we answered that in that section. Daniel's asking, does the TSP accept electronic? Oh, we already got to that one. I'm just trying to find where I'm at on this list. All right. So Heather's asking, if you leave the military prior to retirement and bring over your TSP, can you merge them? If so, are there any pluses or minuses? Now, let me get to a few different parts of that question there. So when you say leave the military, that means you're actually separated from service on the military side. So I want to stress that to folks. You can transfer funds from your service account into your civilian account or vice versa, but you have to be separated from that side. You could ultimately be separated from both sides, but if I want to transfer my military, as you said, you'd have to be separated, fully separated, and you could transfer that over to your TSP, your civilian side. Now, what you cannot transfer in that case over to your civilian side would be tax-exempt pay. So some service members have tax-exempt pay that they've contributed to their TSP on the service side. That cannot be transferred into a civilian account. The rest can. So they can do that with the rest. The form they're going to use is a TSP 65. And it's a simple process, but are there any pluses or minuses to doing this? Yeah, there's pros and cons. I think if I had two accounts, if I had a civilian account and a service account, I'd keep them separate because then I'd have two sets that I can play around with as far as my investments go, if I wanted to. I have two sets of withdrawal options. Let's just say I am still working on the civilian side and I move that service money into my civilian account. Well, I now no longer have post-separation withdrawal options. Now, everything with the CARES Act and stuff like that, this is a unique situation. But under normal circumstances, of course, I would not have any post-separation withdrawal options for that money anymore. If I moved it from my service account into my active civilian account, where I'm still working and I don't have post-service withdrawal options. Now, on the other hand, what if I was still working at a later age in life and I reached the RMD years? If I'm still working on my civilian side, I don't have to touch my account at all if I'm still in an active status of my federal civilian job at 72. So I would maybe want to move that money from my service account. If I still didn't want to touch that money in the service account and I had money in that at that age, then I might choose to say, hey, I still don't want to touch this money, so I'm going to transfer it into my civilian account where it'll be part of my active civilian account where I'm still working, and I don't have to touch the money due to the RMD rules at that point. So there's some pros and cons depending on circumstances. Either way. Is it ultimately going to harm you as far as anything goes, investments or anything like that? No, because you're still investing in the same funds. Now, once again, like I said earlier, if I have two accounts, I can invest differently if I so choose, but it's not like I have, different types of funds to move the money to or anything like that. All right. So the number of the form to suspend loan payments is the TSP 46. Make sure I have that correct. Yeah, TSP 46. That form we created for this. And they'll find this, and that's a good point to bring up also on the forms, is that many of our forms now are only accessible via the My Account section. So you can only get to the form itself in your account. So we did that a lot with the withdrawal forms last year when we consolidated them into the two new forms, the TSP 95, the TSP 99. These are all forms that are only accessible in your account when you go into your account online. So they'll see that, and they'll see drop-down boxes for the ones that they can submit online that we showed you and so forth. All right. Is there a 60-day waiver for in-between loans? And that's another good point to bring up. I don't think I mentioned that, but yes. So as I said earlier, for the general purpose loans, all the normal rules basically stay in place. The big difference with that is that you're using a different form that we created. and the overall limit is now maxed out, gone up to $100,000. It's either 100% of pay, 100% of pay, listen to me, 100% of vested account balance or 100% of $100,000, I should say. So the amounts have increased for that loan. So that's the big difference there. You're still using, it's still considered a general purpose loan. So you have to wait 60 days before you can take out another like loan. So yes, so that is in play here. That's a big one because unfortunately there's a deadline for the, I'm trying to remember the deadline for that. The deadline for the TSP for this new loan is September 22nd. So unfortunately, if somebody already has a general purpose loan out now in existence, the timing of it doesn't work for them. So they won't be able to take one of these loans out this year. They could pay off the general purpose loan they have now, but then they'd have to wait the 60 days, as you mentioned in the question. And when they go to take out that, they'd have to just do a regular general purpose loan at the end of the year. All right. Are loan payments pre-taxed? Well, think about this. The loan payments come out, the loan itself, I should say, comes out as pro rata. So when you take a loan out of TSP, the loan comes out proportionally from traditional and Roth amounts. It will go back into your account the same way it came out. So if I never had Roth in my account, and I just strictly have traditional money in my account, and the whole amount, 100% of the loan would come out as a traditional, from the traditional portion of my account, and then you would, as you're making payments back in, they would go back into your traditional side of your account. Or if you have both Roth and traditional portions, it would come out proportionally from those or pro rata. Are the payments pre-tax? This is where people get a little bit. So you're putting money back in. So yeah, you could be paying tax for the interest. All right. So let's see. All right. So here's a question for Eileen. I think we just answered that a moment ago about accepting forms electronically. So yes, so those specifically, not every form, but you saw the drop-down box, and I'll bring it back. So there are specific forms in the drop-down box that we can now accept electronically, and that's subject to change, of course, like the message said on the slide earlier. You can still mail in hard copies if you want to. You can still mail in hard copies. That's not a problem. Just now you have the option of the electronic. Another question is, will catch-up contributions update automatically for current participants that are over 50, or will they have to opt in? So currently, if you're referring currently, meaning this year, so the old rules, listen to me, the current rules still exist. So current rules of the catch-up contribution being a separate election, that's still in existence for the remainder of this year. So if I was a participant and I'm not doing catch-up contributions and I want to do that, yes, I'd have to go in and opt to start those catch-up contributions. Starting next year, of course, it's the one election, and you won't have to actually go in and do a separate catch-up contribution for that amount. All right, so let's get into the L funds and the big changes that happened that we launched on July 1st of this year. So we retired the L 2020 Life Cycle Fund, and we added 5-year increments. So now we have the L Income Fund, which is for that person that's retiring now and using the money now, or in the next, probably 6 months or so. And very, very soon they're going to start touching this money. We now have the 2025 and then 5-year increments all the way up to the year 2065. So 2065 Sounds like a stretch. It's way out there, but believe it or not, we have participants already in the plan that really should be in the 2065. We have automatic enrollment for those service members. So we've got 17, 18, 19-year-olds coming into the plan automatically enrolled in uniform services that really should be in a plan that far out. Now, of course, these are all still a combined amount of the 5 core funds. So each one of the 5 core funds is put together in some combination to create each one of the L funds. So each one of the L funds has a combination of the 5 core funds. The CS&I funds, the 3 stock funds, and then the F fund, fixed income or more of a bond fund, and then, of course, the G fund, so government securities specifically issued for us. So here's the L funds, the 5-year increments. So now there's a lot of information on here about, you know, what age and so forth and when you were born, and that's what you have to decide which L fund you want to be in. Now, these are all based off of when you would turn the age 63. But you may look at the L fund that is appropriate for you and go, I want to be more aggressive. I want more risk. And you may bump it up by the next 5 years or even further. A lot of participants will do that. I met a gentleman years ago that he was in his 70s and retired, and he was 100% in the 2050 fund at that time. So, you know, it just depends on how much risk you really want to take. Now, theoretically, you look at the L fund that fits your time horizon. Now, I say time horizon, and what I mean by that is, when are you going to use this money? That's when you want to know. When you think you might start to tap into and start using this money in retirement is when you want to target that, because a lot of participants don't touch it immediately. They may wait 5, 10 years or even longer before they start to touch this in retirement. Now, they call these target date funds because they're targeted to a certain date. So those are the years. Some participants don't correlate the two, but those years are the years. The L 2025 is for the year 2025. So what's happening with those funds is those funds are going down a glide path. So the glide path is simply the way the reallocation occurs over the quarters and throughout the years. So they're all working their way down what's called the efficient frontier. So what that means is each one of these L funds, with the exception of the L income fund, is working its way automatically each quarter towards becoming the L income fund. And that's what we just went through with the 2020. You notice the 2020 is gone. We retired that fund, and it at that point became part of the L income fund. Every one of these L funds is doing that same thing. It's just that the 2050, the 2060, the 2065, those are moving at a much slower pace towards the L income fund. The 2025, well, now it's starting to really speed up, become that. And when I say that it's becoming that, it's that every quarter there's a rebalancing of your allocation. Your allocation changes automatically. So it's doing the work for you, basically. So each quarter, each one of these L funds, with the exception of the L income fund, changes slightly towards basically the G fund for us, the G and the F fund. So you're going from, it's that whole risk-reward relationship. So you're going from high risk further out to higher expected returns. So you're willing to take on higher levels of risk, higher risk tolerance, and because you have that time horizon, you have a longer time horizon. So each quarter, it will automatically reallocate and change in that L fund. Now, am I a participant who decides, you know, I don't want to be in multiple L funds? Can I do that? Participants ask that all the time. Well, yeah. We now have the 15 funds. You could theoretically put money in all 15 funds if you wanted to. I don't know if anybody's done that already, but I can tell you that when we had the 10 funds, we had a couple of thousand participants, a few thousand participants that actually did have money in all 10 funds. So there are a lot of different strategies when it comes to these sort of things. I've seen some things where some people want to do a sort of a strategic sort of step ladder kind of process where they use 3 or 4 of the L funds. I've seen that. Now, we created the 5-year increments so that participants could more specifically target a certain time horizon. Because, of course, you had people who were like, well, I probably should be in a 2035, and we didn't have that. Well, now we do. And that person in the past would typically go in and say, I'm going to be, 50% in the 2030, 50% in the 2040, and just split things. Now they can more specifically target their time horizon. So we created these new 5-year increments. So that means we had an existing 5 L funds, and then we added the new 5-year increments. So they're all going down what's called a glide path. And I thought I had left this in here for you, but I don't see that slide. So it looks a little bit like this. So if you notice, and what we're doing too, the whole purpose of this not only is to target more specifically your time horizon, but it's also meant to make the L funds more aggressive, slightly more aggressive. So that's what's happening overall. So a few things about the 2 different sets of L funds. So we had existing L funds on one glide path, and then we now have introduced these brand new 5-year increments. So we put the new L funds on this new glide path that is more aggressive. And the existing L funds are going to transition between now and the year 2033 towards meeting up so that each one of these glide paths will be on the same path. So it's going to take a while for those existing L funds to meet up and transition. So we didn't force anybody into the new, more aggressive approach. It's just going to transition. You can move from one of the L funds to the other L fund if you want to. So if you're looking at this chart right here, to put this in a bit more perspective, these are the 5 core funds in those colors. So the green, the blue, and the green, the blue, and the purple are your CS and I funds. So if you look way out in the year 2065, you can see, and this is the equities. So those percentages over there are the percentage of the whole fund. But you see the equities, the CS and I, the 3 stock funds. If you look at 2065 as of right now, this quarter, you have 99% in those 3, and just a small amount in the G and the F. So you can see much more aggressive. Now, if you go all the way down here, let's just pick one out. Let's just say you want to be in the 2035. Well, the 2035 has the same 5 core funds, but now you're looking at, what's that, 66, approximately 66% in the 2035 would be C, S, and I. So a big difference there, a lot more conservative than those funds that are way further out. But then it gets even more if you're looking at the 2025 or the L income fund. Now, the other thing too about these two is you'll see that the L income fund now has 72% in the G fund. And that's a change because it was 74%. So even on the back end of things, when you get to the L income fund, your account will be a little bit less conservative than it was before. So that's what's happening here. You can see these new funds. You can see, let's look at the drop off between the 2055 and the 2050. So the 2055, the 2055 is in the same boat as the 2060 and the 2065, about 99% CS&I, so very aggressive. And then the 2050, quite a bit of a drop off there because it's off to, 50, 67, 82%. So 82% CS&I. So you can see how things, and you can almost see the slide down there if you just look at it visually. That is the glide path. So it's just gliding down to a more, towards conservative. That's the whole point behind it. All righty. What else did I leave in here for this? All right. Let me grab some questions here in the chat section. So you can submit questions. I've going through this, I should say, pretty quickly here. So don't be shy about questions you might want to submit in the chat section. I'll try and answer them as best as I can. Now, I do realize I may have answered the question that Eileen had about the electronic forms and submitting a hard copy. Let me make sure I didn't say that incorrectly because it's popping into my head. I do want to stress that you don't want to send the forms in more than once. So second part of this is do you still have to mail in the hard copy? That would be a no. So for the ones that you can submit electronically, and maybe I read that question completely wrong, the ones that you submit electronically, you don't have to still submit the hard copy. Now, you don't want to do that. You don't want to send in multiple forms because, as I said earlier, the second form will be just canceled. It won't go through. All right. All right, so Jennifer's asking here to piggyback on are the loan payments pre-tax question. It was always my understanding that loan payments that are deducted from an employee's paycheck are always paid with post-tax funds, regardless of the fund they're going into, traditional or Roth. Normal deposits to a traditional account are pre-tax, but a payment on a loan is a post-tax from an employee's salary. Is that correct? Yeah, basically that is, and think about it this way. Remember that those funds that come out of the traditional whatever tax in the first place, and you're putting them back in, and then you're putting back in the funds from the Roth side the same way. So they're not going to be taxed up front. You're not going to be taxed on the loan payment itself into the Roth. So here's a question about, let's see, from Ricky. It says, what fund is the 1% in for the L2060, 2065, and 55? It's a combination of the G and the F. So all of the L funds have to, and I'm glad you asked that question. So all of the L funds have to have a combination of the 5 core funds. That's the way they're set up. That's, we didn't have to go to Congress to ask for these new 5-year increments. We didn't have to do that sort of stuff because we're just taking the 5 core funds and making these life cycle funds. So ordinarily, let's just say we wanted to create some sort of specific fund in addition to the 5 core, then that would take legislative changes for that. So it's much easier to take the 5 core funds, create the L funds that we created before, and then now we're adding new 5-year increments. It's the same 5 core funds, but they're all included in each one of these. So yes, it's a little small amount, and maybe I'll try and bring that up and show you on the website because I haven't even looked at it myself to see what the way it looks on the website for that. Maybe I'll go back to the website and bring some stuff up. We have a lot of time here. So let me go back. Here's another question on sending in the electronic copies. Now, I will tell you that I just went to my account just to look at it the other day and see, but let me just go back real quick to the slide because this drop-down box, there it is. So you're going to use the drop-down box right there, select form, and these are the forms that are currently available. So a participant won't be able to submit anything but the forms that are currently available to be just submitted online. And as it says, it could change at any time. But right now it's the TSP 3, the TSP 20, the loan application itself, and then the other loan forms, including the general purpose and the residential loan forms, the automatic enrollment refund requests, the CARES Act loan and the CARES Act withdrawal. If you want to combine those accounts, like somebody asked earlier about combining a civilian and uniform services account, that TSP 65 and the TSP 75 and 76 are currently the forms you can submit this way. Now, I will tell you this too. In addition to what you see here, with the changes last year, the TSP 99, the TSP 95 forms, so the post-service withdrawals, There are some participants that can submit that completely online and not have to submit it, mail it, but they can submit it online. So there are some cases that existed before. All right. So James is asking here, and I'll just come back here, are the taxes applicable to each L fund you contribute to, or is there a tax advantage in contributing to multiple funds? That's an interesting question. Oops, went too far here. That's an interesting question, and I'm surprised I don't get that more often, but you're not talking about specific taxes for an L fund, because when you go to take the money out, first of all, when you take money out of your TSP right now currently, as far as the funds themselves go, it's going to come out pro rata from that too. So you don't have the option to specifically say, I want all of my money to come out of the C fund or the S fund or the I fund or anything like that. It is going to come out of whatever funds you have money invested in pro rata at that time. So that helps answer that question just a little bit. But as far as taxes go, remember, this is just going to come out, and what you owe in taxes will be determined by not only your TSP, of course, but the other income that you have in that year. Now, TSP is taxed as ordinary income. So that's a little bit, you might want to know that. But it really is, it depends on what your other income include, along with your TSP that you would be taking out, any kind of taxable portions or withdrawals, I should say, that would come out. Now, of course, you also need to consider when you're thinking about that, of course, Roth versus traditional and things like that. But very specific to the funds that your question is asking, the taxes are not applicable to any specific fund, the core funds or the L funds, and there's no advantage. The tax advantage would be in the Roth versus traditional. So if you want to gain some tax advantages, potentially, then you would want to consider contributing to your account as a Roth contribution and maybe get the long-term benefit of those Roth contributions that could be tax-free earnings. And maybe pay taxes on the contribution itself at a younger age or in a lower tax bracket or whatever the case is, ends up being. But that's really where you would have the ability to give yourself potential tax advantages, would be in the difference between Roth versus traditional contributions, and then when you go to withdraw that later on. All right. I've gone to the website I've gone to it once. Maybe I'll go back to it in just a bit. But I did mention this earlier, how you get to your account. You just click the little login now, a little bit different there. And that will take you to your account, the My Account page. And you put in your account number, password, and so forth. That's easy to understand. So if you want any contact information there, the Thrift Line, of course, is going to give you the ability to do things over the phone or even speak to a live participant service rep. Now, you can do that between Monday and Friday, 7 a.m. to 9 p.m. Eastern Time. You'd hit number 3 on the phone, and you could get a live person at one of the call centers. Now, forms, and I'll show you that a bit, too. That's changed. Well, I already did show you that. Sorry about that. So tsp.gov/forms, you can get right to where our forms and it used to call it publications. Now it's called forms and resources, I think. I think they changed that. So that will get you to that page. What else do we have here? So the webinars that we're doing, tsp.gov/webinars will take you right there. We have some dates for the rest of August and September and into October that we hope to get out very soon. You do have to have access to, and this is a good point to bring up to you guys. You guys might be able to help out with some of this stuff. Some participants think they have to do this via a work device. They can do it any way they want. Any internet-connected device, they can register, attend our webinars. They don't have to have a WebEx account. They do have to register. We do require registration for the webinars. So if they want that information and the registration links, all they have to do is go to tsp.gov/webinars. We do record some of the webinars, and we place those out. And we put new recordings up periodically. We have a YouTube channel, and you can get there by just putting it, go to YouTube, or you can click on, I'll show you that also a little bit. TSP4Gov is our, what we use to get into all the social media. So TSP4Gov, the number 4, not the word, and they're the webinar playlist, or you can use this link right here that you see on the slide. All right. So here's a question from Rita. Says, for Avira, when can I do a withdrawal without penalty? Now, what do you mean by Avira is not going to be not going to affect the early withdrawal penalty. So that's getting to the IRS early withdrawal penalty. So things like early outs and those sort of things that you might get and be able to leave and retire at a younger age, those don't affect that IRS early withdrawal penalty, okay? So that's a very important point to bring up. If you were able to do that at an age younger, now some of the exceptions for the early withdrawal penalty include working into the year you turn 55 for everyone. So if you work in your federal job into the age of 55, that's one of the exceptions to early withdrawal penalty. So for your MRAs, everyone would satisfy it that way. Now, they did also drop that age down to the age of 50 a few years ago, and that's for public safety employees only, though. So for everyone, if you work into the year turn 55, that's an exception. If you are a public safety employee, so law enforcement, firefighters, air traffic controllers that are in a designated public safety employee position, those you would have to work into the year you turn 50. So it's a little bit different there. Now, they would have a P code on their account. Most of them will. Not everyone does, because there were some folks that were, submitted prior to that, and they haven't gone back in and changed those. But they could have a P code on their account that would designate them as a public safety employee in our system. But they could ultimately still file taxes and things of that nature if they didn't have the P code in their account. So just keep in mind, anything that's like an early out or anything like that is not going to change anything with that IRS penalty. That would still be applicable. Now, there's some other ways you can touch your account and not have the penalty. You could take out installment payments based on life expectancy. We sort of referred to that earlier. So life expectancy payments as a post-service installment option would not be penalized. The life annuity, so our life annuity that goes through MetLife, is not penalized either. So there's some exceptions to it, and there's some ways you can actually touch the money prior to the age of 59 and a half that you would not be penalized. All right. So Stephanie's asking, what are the benefits of doing a percentage deduction versus a flat rate amount for your TSP? And that's a really good question. I think the important thing about doing a percentage versus a dollar figure for your contributions is, do you intend to reach the limit? So if I intend to reach the limit, now we talked about the spillover effect earlier and how that will change some things next year for folks that are eligible for catch-up contributions. What about those folks that are not eligible for catch-up contributions next year? Well, they still have to spread the money out over the year. So remember, they still have to put in 5%. So in that case, if I intend to reach the 19.5, then I'm probably going to want to put in a dollar figure. It's easier to calculate and so forth. On the other hand, if I don't intend to reach the 19.5, doing a percentage might be a good thing to do, because if I don't intend to reach the 19.5 and I get a grade or step increase during the year, then my contribution amount will automatically go up due to the percentage that I have on file. If I'm contributing $700 a pay period, and I get a raise at work or anything like that, it's going to stay at $700 going forward. And maybe that's something I wanted to do, but maybe I want every time I get any kind of raise or increases, I want my contribution to bump up just a little bit by the percentage. And that would be good for someone, like I said, that doesn't intend to reach the limit or isn't reaching the limit, I should say. So those are things I would consider for that, doing, the difference between a percentage or a dollar figure. But ultimately, it's the same amount going in if I'm reaching 19.5. It's just that I want to make sure that I'm taking advantage of other things if possible. So Luann is asking, is everyone MRA plus 30 or more eligible correct? Yeah, I mean, like my MRA, and I'm not counting, by the way, who isn't, is 56 and 10 months. So it goes by, the year you're born, the month you're born, and determines what your MRA is. So if you reach your MRA and you have 30 years of service and so on, that's all. And it's really good information, but it's not something I'm going to be covering. That's something for you guys to do on the OPM side of things. But it really doesn't play any role in the early withdrawal penalty, other than the fact that if you meet your MRA, you have the plus 30, you're going to be working into the you turn 55 and further. So, it doesn't play any role in the early withdrawal penalty. It's just in those cases you will have worked into the you turn 55 or older. All right. So here's a question from Maria asking, if the TSP contribution and catch-up contributions are going to be merged next year, does the employee continue using the TSP1 along with the catch-up contributions form? Now, a bunch of our forms are going to go away. I'm pretty sure the catch-up contribution, I don't know how much they alter those forms for next year. But let me go. That's a good question. While other folks are thinking about or submitting any other questions, I do want to bring up the website, and we can take a look a little bit at what's already up there. There is a bulletin for that. I think we created a bulletin just to announce it. All right, let's go back. All right, you guys should see this and make sure you're seeing the same thing I am. There you go. So under news and resources, one of the news things we put out, I'm trying to think how long ago it was. I don't know if we still have this up here, but it's a good way to see what's up there as far as the old bulletin. So this is basically the old bulletin board material section. So we had maybe not, just a second here. All right, you know what I'm going to do? I'm just going to go to the agency and service rep resources. Just go to the bulletin. So we do have a couple of bulletins went out last year. You know what? Instead of taking all that time, let's just put in Spillover. Take us right there. Oh, that's that 20-1 there. So there's a whole section. This is what I'm trying to get to here. I told you folks I'm still learning the website, just like the rest of us here. It's all, when you've been using that website, I've been around long enough to remember when we didn't have a website at all. So gotten used to that. But here is going to tell you all the different layouts of how the spillover works and so forth. And as far as the forms go, I wanted to confirm that maybe we don't have that information. There it is, right there. So starting next year, we'll no longer use the form TSP1C or the U1C because that was specific to catch-up contributions. So the TSP1 will be updated. So a bunch of our forms are being updated, have been updated since last year with withdrawals and then these forms. So make sure you have current forms any kind of older forms, to get rid of those and so forth. But yes, we will be getting rid of and no longer using, I should say, January 1st of next year, the TSP 1C or the U1C. So this will also give you a little bit more detail and information on how that's going to work and so forth. So I encourage you to take a look at this and read up, because like I said, this is a little bit more detail than what we're doing here. So I also want to point out where you can find those recordings of our webinars that we do. Just click on the YouTube thing down here, the little icon. And we do have a list, and these are all good resources for participants too. We have a couple of podcasts in here. We have videos. We have the webinars. I'm waiting for it to come up here. Or not. All right, there it is. So there's a video playlist. I mean, there's our webinar playlist right there. We have some videos and podcasts and so forth. So this is a terrific place for participants to go get some of that information that's already recorded, and they can listen to it and watch it anytime they want. I remember what else I promised you I would point out if I went back to the website here. Funds. So here, learn about the fund options. Go to life cycle funds, and you can see the different L funds. Now, in these, you can go to any year and bring up what it would look like. So right here, you can click on you can see right here in the 2065, the gentleman asked, or somebody asked earlier about the G and the F fund. Are they still included and what percentage? So you're looking, this is the quarter we're in, July of 2020. So the G fund would be 0.35% and the F fund 0.65%. So the full 1% difference there. And that's a good way to look at it here, because this also shows you, yes, that all 5 core funds are in here, and these are the percentages. Now, if we want to go out into the future, so I was trying to bring up here. I don't think I'm doing this right. There you go. So you can just go to this right here, the composition. You can see the same thing we just looked at, and you can see. But what's cool about this is if you scroll it along, you will see that G and F fund still only equals 100%. I mean, I can't speak today. Sorry about that. Still only stays at the 1% for a very long time. So way out to the year 2036, 2030. So those G and F funds would still stay at 1% in the 2065. So those folks are going to stay in a 99% CS&I composition for a very long time, because, like I said, they had plenty of time to stay aggressive like that. And then if you just keep scrolling down, now you can see what's happening. This is the glide path that I was referring to earlier. So that glide path is what's happening there, is now that things are starting to become more conservative at a more rapid pace. Now, one thing I do want to point out here too is, even though I'm saying 99% CS&I, well, those percentages change a little bit in that section too. So your C fund actually grows during this period for a while and then stays sort of steady and then goes down. So this is a cool way to look at it and spend some time. The website really does offer you a lot more detail that you can sort of visually see, different than what we had before. All right, to show you everything I promised you I would show you. Well, here's all the old, what we used to call forms and publications, and it says it there, but then the other one says news, forms, and resources. So that's why you find all these forms, and you can break them down by topic and so forth. But you'll also see that if you go, say, to the withdrawals, if you bring up the TSP 99, or let me see, let me bring that one up, or like the 95, here's the 99, that it should tell you that you have to go through your account. There you go. So it'll take you right to your account. So any form that you have to go into your account to access and submit and fill out, I should say, it'll take you right to it. There are still some forms that you can do directly. You can print out directly, or you can go into your account for. All right. So here's a question from Harriet. Says, what is the most important information that you would like us to share with our employees? Let's see. That's a terrific question. You really put me on the spot there, though. Tell them to read. No, just not kidding. Well, you know what? And that's a really good question. You know what I tell participants all the time? Some things I tell them all the time is, everything can change. There's always improvements on these things. I mean, first and foremost, you want to build your account. You want to contribute. You want to take advantage of this plan as much as possible to build that account. Now, I can't give advice and tell a person to not do this or not do that, but you're trying to build this account for use in your retirement. This is the part that's going to really play a huge role in getting you to higher percentage replacement numbers. So in other words, this is the part that's going to add the extra, percent to get you up to 70, 80, maybe 90% or even more percentage replacement of your income, of your working income. This is the amount that's going to get you there. But you have to take advantage of the plan. You have to invest. You have to consider certain levels of risk. You can't be 25 years old and sitting in the G fund. You can't be 45 or even 50 sitting in the G fund 100%. Probably not the best place for you. You want to contribute to that account and build that account. And give us a call. Call our thrift line. Ask questions. They can't give advice either, but educate yourself on whatever, on the plan as much as possible. So that knowledge is going to be very beneficial. But you first and foremost have to contribute and build the account. All right, let's see. Crystal here is asking, is the TSP 19 form still being used? It's not listed in the forms section on the website. It is still being used, and I'm not going to drag everyone back to the website again, but because I'd have to look for it myself. I haven't looked up that particular form. The TSP 19 used to be attached to one of our bulletins. I don't know the number off the top of my head, but it should still be attached to that bulletin. Now, if you do a search in the little search engine, you probably bring it up that way too. But it does still exist. Basically, your question is asking, does it exist? It still does. Now, it's not a requirement. The TSP 19 is not a form that's required. The biggest difference between the TSP 19 form and some forms that agencies have created themselves would be the fact that they generally will do one thing. They generally leave the loan information off, and that's where the mistakes come in with that. But the TSP 19 does still exist, and it's I'll have to look it up and see exactly how you get to it. But just put in the search thing, TSP 19, it'll probably bring you to that bulletin where it's attached to a bulletin. At least it used to be. I'd have to go and check. Maybe they changed that one on me too since they launched the website. I'll have to follow up on that. All right. Here's a question that do new hires still need to wait for their user ID and password in the mail, or is it possible to agencies to send TSP new hires work email address for communications? So new hires they're still going to get an ID and password in the mail. They're still going to get the welcome letter, as we put it, with information and so forth there. Now, what they can do is go in and change passwords and PIN numbers over online. So they could call us up and speak to a participant service rep, and they'll walk them through the process. Or they can go online or through the phone line, through the Thrift line, and change passwords and PIN numbers. Now, their actual account number, they would still have to have that mailed to them. Now, I always encourage people. Well, like I said a second ago, new hire is going to have that welcome letter that's coming out to them, and the password is going to be mailed to them. Now, could they call up if they haven't received anything in a reasonable amount of time and find out? Yeah, sure. That's what I would encourage somebody to do. If they haven't received that in the mail, or if they've changed addresses, recently, they could always call us up and see if their account has been established. The 06 record has to come in and establish the account, and then that'll generate all of these messages going out to them. But they can call us up and change passwords and PIN numbers over the phone. So Karen's asking, previously, employees with the catch-up contribution had to complete a new catch-up form every year to continue. Next year with the spillover, does that stay in place? And that's a terrific question. No, the requirement for that separate election won't be there the following year. So they have to. Now, you still have to contribute, but you'll be contributing initially as the regular amount, the elective deferral amount, that $19,500, and then spilling over. So they won't have to make a separate election for that. So they would not have to restart it the next year. So here's a question: did I correctly hear that the TSP 19 is no longer required? The TSP 19 never was a required form. It's an encouraged to use form, and most agencies will use that, but we never did require agencies to use the TSP 19. We encourage them to use it because it has all the information that that should be sent over from the losing agency to the gaining agency, but it's not a required form. All right. Not sure why we never made a required form, but to my knowledge, it was never a required form. And many agencies, like I said, do use that form, and some agencies have their own form they use. All right. So I am at the end with the questions here. Let me just go look real quick. While some folks might want to submit questions. I do hope this was, I hope it didn't go through everything too quickly. I will tell you with the COVID-19, the CARES Act stuff, I really would encourage you to have those participants either call us up with questions or go to the website where all that information is and really read up on that pretty good. Because I don't want to put any, this is all sort of fluid, brand new information. And, putting you guys on the spot to have to answer those specific questions, it's all new. A lot of it's new. But I think the most important thing to understand what the CARES Act stuff is it's temporary, and you have to be a qualified individual, as we went through earlier. That's important to understand, too. So Darlene's asking, so is it safe to say that agencies can still request that the TSP 19 be completed? Certainly, yeah. I mean, yeah, we would like for everyone to use that TSP 19. That's like I said, and you guys all know it. A lot of you are probably been around for a while, and I don't know the makeup of the listening audience here, but I'm assuming some of you have been around for a little bit. And the participants, the biggest thing that gets left off from changing one agency to another agency is oftentimes the TSP loan information that is not included with the information. So the 19 request that information also. And, excuse me, participants are not always, that anxious to put that on their form, and they think sometimes, hey, I don't need to make those payments, but they do. And that would be helpful if they submit that form was being used by both agencies. So Samantha here is saying that our agency still uses the TSP 19 form. I ask of it from other agencies for employees that are transferring to our agency. So see, there you go. I know a lot of agencies use it. It's not a required form. All right, let's see. This is a good question. I'm glad you brought that up. I'm sitting here trying to think of things that have changed recently that I can talk about now that I didn't put in the slides. But yes, the RMD, and that's a good thing to bring up. We can talk about that for a little bit. So something called the Secure Act passed last year. Now, the timing of this was kind of interesting because, of course, the law passed sometime in December. So it really didn't give a whole lot of time because a lot of the changes in the Secure Act went into effect on January 1st. So a couple of weeks later, they went into effect. So one of those being that they changed the age for RMDs to 72. So if you're not familiar with RMDs, that's a required minimum distributions. And that is where a participant, if you are separated from service, and that for us would apply to your service, your federal civilian service, at the age, it used to be 70 and a half. So the year you turn 70 and a half. Well, beginning this year on January 1st, they changed that to the age of 72. So now you can work. I mean, you can leave your account alone and not have to do anything at all. It's still invested. It's still in the funds. It's still growing. You should be managing it, making sure it's invested the way you want it to, but you don't have to touch it until the year you turn 72. So that's a pretty big change there that went into effect pretty quickly. Now, of course, if you're still working your federal civilian job at age 72, you don't have to touch your TSP at all. That's very, very different than IRAs. IRAs also changed to 72, but if you're working or not, you still have to touch the money in a traditional IRA at 72. So those are some big differences there. I'm trying to think of the other parts of the Secure Act that changed. There was a few other things that changed within that affect things related to plans like this in some ways, but not directly. Okay, Bernice has a question here. And it says, if you suspend your payments, will you have to increase the payment amount or will the loan be extended for the month the payment was suspended? So it will be suspended by the number of months. So let's just say you did it right now and you were suspended for, say, 5 months. Well, if you had taken the loan out for, say, 4 years, you're fine because it would just tack on the 5 months to those 4 years, and you'll keep making payments for an additional, you'll not keep making payments, but you'll make payments to a later date. But let's just say you took out that same loan and you took it out for a full 5 years. Well, now it still has to stay in the 5-year window. So the general purpose has a max of 5 years, so you still have to stay within the 5 years. That rule did not change, but so in that case, you're probably going to have to reamortize the loan. Depends on the situation, but in most cases, you probably will have to see, and that will be an automatic reamortization. So the system will automatically reamortize that amount for an increased payment amount. And you can only suspend through the rest of this year. So it's going to only be suspended through the rest of 2020. So his question says, can you please repeat that for employees working at or beyond 72, the RMD is not required until after separation? Is this a change from the previous rules? It's not a change from previous rules. Generally, when this gets talked about, sometimes participants will get this confused with IRAs. Always got to remind yourself that TSP is not an IRA. And we get that all the time, too. IRA stands for Individual Retirement Arrangement. So it's an individual account. We are certainly not individual. We just went over 6 million participants in the plan. And the last time I looked at the beginning of this year, or at the end of last year, we had somewhere around 50,000 or so millionaires in the plan. So not quite an individual account. But yes, the IRAs, you know, those for traditional IRAs, they have the rule that you have to start touching it regardless of where you're working at age 72. In TSP, since we're an employer plan, you have to be separated from your plan, okay? So, or separated from your service, your employer. Where's that? Okay, so yeah, so for TSP, that's pretty simple. If you're still working now, we're talking about your federal job, and many folks do work past 72. If you're still working, you don't have to touch it at all until you separate. The RMD rules will not kick in until you separate. So if you work to 80, at 80, that's when the RMD rules start to kick in for you if you separate at that time. Here's a good question, sort of a follow-up from Pauline from the other questions about the loan payments and suspending the loan payments. Does the interest continue to accrue? The answer is yes. So the interest does continue to accrue, and that's the same in the past when we, you know, if you put your loan on hold for leave without pay, for approved leave without pay, interest does continue to accrue in those circumstances also, but the same thing is going on here. And that's part of the reason why it might have to be recalculated in some circumstances, depending on the you know, whether you're staying in the 5 or 15 window and so forth, but the interest will continue to accrue. Now there is that deadline at the end of the year, November 30th, so you'll have to get that done. And, you know, if you do that, then there'll just be a couple of payments possibly for a loan not to come out, but. And what I'll do too, well, I got a few minutes here. If anybody wants to submit more questions, is we've had a lot of changes this year, and really, you know, we had a lot of stuff planned for changes, the L funds, and so forth that were happening this year. We had a lot of legislative changes that kicked in, and of course, the CARES Act stuff. So there's been a lot of things that are changing. I think one of the important things to understand is the CARES Act stuff is all sort of temporary changes. The other stuff that we're talking about, the L funds and so forth, these are permanent changes moving forward. And we just released the information about the PIV cards and the loan installment payments based on life expectancy that we discussed earlier. That's brand new information out there. That's a big change. I think those are pretty big changes there that participants might want to know about. So while I have a moment or two here, I will go back to the website real quick. And I want to show you, oops, that's not what I want to do. So on our website, and this is one of the things we struggled with the webinars that we do too. If you have anybody that comes and asks, they're having troubles getting into the webinar that we're hosting and so forth. It is under there. You can put in tsp.gov/webinars. You can, and that'll take them directly to the training page. Oops, didn't do that right. Or you can go down under the Rep Resources section, and that'll take them to the same training page. We're going to have some updates to this page real soon. We have a double bit of information here. Apologize for that. But they can go directly to, and we do have some CARES Act loan dates for, we're going to do, basically we decided to start doing a monthly date for the CARES Act loan, CARES Act withdrawal. And so we'll have, a date for September and October, and one in a couple of weeks in August. And this really does a deep dive into the CARES Act loan and withdrawals, and whatever we have as the current information at that time. We do a series of other topics, the intro to TSP. We dive down specific to these things, to contributions, to investment funds, to loans. And like I said, participants often get a little bit frustrated because they have to register with WebEx and use WebEx, that sometimes agencies and service will block WebEx. Of course, we can't use all of the systems at the same time, so we have to choose one. That's the one we're using right now. But if you go into one of these are all older dates because we have passed, they would just click on to register and it'll take them to the WebEx page to register. So what I encourage participants to do is, even though you might want to use this at work, if you can, register with your email, your personal email address, because that way you make sure you'll get the confirmation notice. Some agencies and services will block the WebEx. They'll let them get through somehow, and then what participants tell me is they're not getting the message that it's blocked or this or that. So I can't account for all of that, but they can use personal email addresses to register. They would need access to that message to be able to attend on the date, but we are still doing training. So if your agency or service has a system that they're using, WebEx, Adobe Connect, excuse me, Adobe Connect, we can generally get into. We're actually putting together a tech information for this section because things like Zoom, we can use the web for Zoom, but we can't get into certain parts of it. I'm not an expert on those areas, but we are doing training, and if your agency or service wants us to, I was going to click on this, wants to do training specific for your agency, give us a call at this number for the 202-942-1450, or easier than that, just submit something to training@tsp.gov, and we will work with you to try and set something up. So we're trying to replace the normal, typical live events that we will do with as much electronic and virtual events that we can participate in. But like I said, that's the stuff that we do that you're going to host would be dependent on our availability to be able to access it according to our agency's rules and so forth too. So that will play a role there also. So that's all in the same training section here that'll give you that information. All right, so I see a couple of questions did pop up. Or maybe one or two. Actually, so his question says, do you have a recommendation on how we can locate publications easier? So the form, just put in tsp.gov/forms. I know I did not plan to go back to the website this often, so I do apologize if that's making anyone dizzy here, but I'll use my own website and make sure I'm doing this correctly here. If you put in tsp.gov/forms, it should take you right there. So there you go. There's all the forms. Now the forms are this is a little bit different too, and it takes a little bit getting used to it. But down, so if you want more than the few that they pop up automatically, that's the forms. Now that's going to be your TSP 1s, your TSP 20, TSP 76s, 75, those types of things are going to be located here, or you will click on the form and it'll take you to the My Account thing. And down here at the bottom is all the different publications. So these are the publications, the booklets, the summary, the the various fact sheets, tax notices that we put together, the death benefits booklet, all those different types of booklets are listed right here. So you can scroll down there. And I was going to see also, let's do this since I went back here. Let's put in the TSP-19. Somebody had asked about. See if that comes up. No, it's coming up. Let's see. There it is. So there was a bulletin last year on a revision of the TSP-19. So there it is right there. So this is a question a couple of folks had earlier about the TSP-19. It still exists. It's still there. The easiest way is just put in TSP-19 into the search at tsp.gov. And if we take it off here, we used to tell folks that it's not a required form, but maybe we didn't take it off. Okay, so that's the TSP-19 there.
You can hear me.
All right, a few more questions here. Question says, some of the publications that I'm so used to finding I can't find so easily. Tax information. So you're going to look in that same section. The tax information will be in the sections for the outside of the form. So when we looked at it just a second ago, if you go to the withdrawal section, you can click on withdrawals. Then you'll see a first section of forms, and then down at the bottom, like the publications section, would be more of the tax notices and booklets and things of that nature are going to be in there. Or once again, if you know a specific tax notice number, you could probably just put it in the search real quick and bring it up. Here's a question that says, automatic 5% that starts October 1st is the middle of the pay period. Will it become effective the first pay period after October 1st? Yeah, I mean, it would become effective after that. So beginning on October 1st, now let me just stress here, this means a person would come on board and start October 1st going forward. So it's not going to affect anybody who's currently in. So if I'm a current participant, and then the automatic enrollment all the way up until October 1st, prior to October 1st will be the 3%, then it switches over to the 5%. So that'll be for new folks coming on board after that. So it would depend on the start for that. There's a question that says, when an individual takes out a loan, do their contributions stop? And that's a real good question. Under normal circumstances, a person, I shouldn't say normal circumstances, in many circumstances, a participant will continue to contribute even though they've taken out a loan. So they'll have both. Now, they can stop currently the loan payments for the remainder of this year for the COVID, but they don't have to. Now, the other thing that used to confuse folks a little bit with that is the hardship withdrawals. So we did change that also. I'm glad you brought this up. That was another. I told you we had a lot of changes happening right now. So last year with the withdrawal changes, we changed and actually did away with the rule that you have to stop contributions when you take out a hardship withdrawal. So you no longer, we did away with the 6-month non-contribution period. So when a person takes out a hardship withdrawal, they can still contribute to their account. They don't have to wait any period and then restart them or anything like that. All right, well, we're about to wrap up. Somebody asked about the tour of duty and the certificate. We're just about to wrap up. So we'll go ahead and do that. All right, go ahead and wrap things up. Not sure exactly what I'm supposed to do at this point. Let me get Anita. All right, well, I'll go and wrap things up at this point. So I'll thank everyone for listening in, and I hope this helped you. A lot of information thrown at you today, but it's good information, and I hope that was helpful. So thank you for having me and sticking it out and listening in. So I'll go and wrap things up for myself. I don't know what I'm supposed to do to close things out other than just say goodbye and to have a good luck with your TSP. Good luck with dealing with participants in the TSP, and take care, everyone, and have a great day and a great week coming up.